All right, welcome everyone. Thanks for having me here, David. And today we're going to talk about trading options in a unique way that you've never seen before. We look at automation and some algo-driven option spreads. And we're going to look at one of our favorite indicators, a proprietary indicator called the RTI. So we'll show you that. And of course, we'll run through a demo and we'll look at our one-touch trade alerts as well. People absolutely really rely and lean on those trade alerts, and we'll show you why they're so unique. So once again, thanks for having me here at the Synergy Traders event. I always enjoy checking in on the presentations if I have time. So there's a lot of great information and material out there. Before we jump in, let's look at what we're trying to do here, folks. We're speculating on price and we're trying to profit. So that's the whole idea of trading. We're trying to make money. It's just that simple. However, with profit, there is always risk. So I need you to take a moment and look at the risk disclosure there. Probably the most important thing to remember is you should be using risk capital when you're speculating, and that past performance does not guarantee future results. How many of you are familiar with a chart like this? That's a lot of choppy action, and that's not what we're trying to do here, folks. Completely different approach to trading. We're going to look at trading stock index options using our proprietary indicators and automation. You don't want to struggle like this poor guy here. You want to be more like this robot with technology at your side. A little bit about us first. Altavest, since 1997, folks. We've been a registered introducing brokerage firm, and we've doing this obviously for decades now, trading millions of contracts. We're registered with the CFTC and a member of the NFA. We're headquartered here in California. And there's the regulatory agencies that oversee our industry. And like I said, we've traded millions of contracts over the years. I think that might qualify us as somewhat of an expert in the futures and options space. We often get quoted on various publications. This was just actually a couple of days ago here. You can see us here on Market Watch. So maybe you've seen us before, but the whole idea is we don't want you to be like this poor gentleman here in the basement trying to figure out everything by yourself. Use our experience and expertise to help you along the way. That's what we're going to show you here. And a little bit about myself. I've been doing this about 30 years now. The time is ticking here. I have a BS in Business Administration from the University of Southern California, go Trojans. And I'm a co-founder, of course, of Altavest, licensed over about 30 years ago. Been doing various webinars, especially since the pandemic. Maybe you've seen some of them before, and if not, hopefully you'll like what you're about to see. I began in securities with mutual funds and variable annuities and so forth, and eventually got my Series 3 commodity futures license, as well as my Series 65 investment advisor law as well. So that's a little bit about myself. And with that said, what I'll do here is I'm going to go ahead and stop the video. That way you have a little more room on the screen. We're just going to run through this very quickly, a little bit of background, maybe some context on the environment we're in right now. Inflation and consumer sentiment. U.S. producer prices soaring at double digits for the first time. Look at that here. We're just going to go through these quickly. U.S. consumer prices, fastest acceleration in 40 years, highest since 1981, 8.5% year over year growth. There's the CPI index, consumer price index. You're probably very familiar with those prices, moving up, up and away, inflation jumping again. Inflation expectations hitting record highs, hope crashes to 8-year lows. Here are the inflation expectations charging higher. Liz Ann Saunders, 84% of Americans plan to cut back on spending as a result of higher prices. We can all relate to that. Here's an economic shock hitting the housing market. Guess what it is, folks? Interest rates are soaring, their highest level in a decade. Look at this here. Look how quickly those interest rates are moving higher. And look at this here. This is all you need to pay attention to right here. In 9 months, the rates have gone up almost 2%, 187 basis points in just 9 months. Home sales are slumping near 2-year lows as mortgage rates soar. Commodity prices, look at this huge ramp up here. Strongest start to any year for prices since 1959, over 100 years. So everything is red. CPI, PCE, core PCI, core CPI. How about energy prices? Well, we all feel it at the pump and the yield curve. I'm not going to jump too much into that, but we're going to look at oil here. You are very well aware of those oil prices, just about doubling here. And look at this, oil surges to its highest since 2008. It's come off a little bit since then. But look at this here. The EU is going to impose a full embargo on Russian oil next week, sending prices to 185. That's according to JP Morgan. So they're just waiting for the French presidential election to be over with. And then they're going to do that. And according to JPM, at least. So something to keep an eye on. But what about the economy? What happens when oil prices keep escalating? Well, what happens, of course, is let's take a look. The Fed can be forced to raise rates while going into a recession. We're looking at the yield curve. All we need to know here is when this gets negative, that's a harbinger for recessions. And look at this here. JP Morgan admits that central banks need a recession to cure inflation. So in some ways, the Fed wants to raise rates to try to create a soft landing, but that's kind of a needle to thread there. So what happens when the Fed hikes? Well, here's what kind of the pattern is, at least in the last 10 recessions. First of all, the Fed is too easy with their monetary policy like they have been. That creates energy inflation like we just saw, and that makes broader headline inflation like we just saw and like we're feeling. Then the Fed begins to tighten their policy. And then in 10 of the last 10 times, this has caused a recession. So we better keep an eye on this, folks. The Beige Book just the other day mentioned here demand destruction, elevated input cost, soaring prices, negative sales impacts from soaring prices, rising prices, expected inflationary pressures to continue. The market's expecting the Fed to hike 9 times this year. But this is interesting here. Look at this. But then after they hike, it's going to do so much damage. The forecast here, the forward-looking guidance suggests they're going to have to cut in 23 and 24. So, and the Fed always screws up according to this article, and US stocks will be in a bear market by summer. So we shall see, but keep in mind the Fed is consisting of these members here who really have no real world experience in anything. They've never signed payroll checks or run a business or anything. They're all been at the Fed or just in academia. So what about earnings? Will earnings save us? Well, how about this? 67 of the S&P 500 earnings have been reported, negative 7.6% year over year so far on the aggregate. And of course, you know all about geopolitical risk. I won't go into it, what's going on with Russia and Ukraine, but that's not going to be favorable. And it certainly hasn't been for the markets. So how do you actively trade in an environment like this? What about day trading? Is it true that only 1% of day traders are profitable? Well, I want you to think about these 3 common barriers to trading. See if you can relate to these. And also I want to welcome you to encourage you to put questions in the chat. I don't get it to see it right away because I'm going through this, but I will probably answer a lot of it as we go. But I want to hear from you, and let's take a look here. Is there a 1% success rate? Well, according to this study here from Wealthfront, Charles Schwab studied their active accounts for 6 years. Active traders substantially underperformed a simple low-cost index fund. How about this one? Out of Taiwan, only 1% of the traders consistently beat the market. And out of Brazil, only 3% made money. And look at active fund managers. 79% underperformed in 2021, and 86% have underperformed in the last 10 years. And I don't want to pick on Jim Cramer, but here's his buy recommendation on Netflix. You know what's happening since then. And here's another one on Coinbase. The point is, it's not that easy, even for the professionals, to be stock pickers. And, social media, do you want to rely on social media? You want to rely on these kids here that suggest they have found a glitch in the stock market? How about this kid here? His parents gave him 500,000, according to what he says, and now he's lost 96% of it. So you want to stay away from this kind of thing, folks. We're too smart for that, aren't we? Don't buy into all the stories. But what about if you are trading, are you even beating the markets? Are your efforts even worth it? Well, here's a study. It suggests that the simulated trading environment here, 100 monkey portfolios, says here that 96 of the 100 outperformed the benchmark by 1.7% per year. So there is your trader of the year right there. That's who we should be hiring. And emotions, how many of us can relate to this? Let me pause for just a second, get a sip of water, folks. Okay, got a little frog in my throat. Emotions can be expensive trying to convince the markets that you are right. That's from Ed Sequoia. He's featured in the book Market Wizards. Highly recommend that book. And Market Wizards, the second one too, with Stanley Druckenmiller. You got to learn about how he does it. But you don't want to end up like this, still thinking the market was wrong all the way into the grave. You want to stay off this roller coaster of emotions. You're optimistic, you're euphoric when you're making money, you get despondent when you're losing, depressed, and then you're optimistic again. Stay off of that roller coaster. And there's a lot of noise to navigate, all the pundits, the bulls, the bears, the talking heads. But really, Motley Fool, I think, sums it up well. Our worst financial enemy is us. We can get biases here. We fall into these traps: confirmation, anchoring, and recency bias. And I think this one image here sums it up. So I think we've all fallen into this this trap where we make some great investments and we feel like we're a genius afterwards. And that's probably the worst thing that can happen to you. You get overconfident. But remember, algos have no emotion and they're dominating the landscape. What percentage of the trading is algorithmic? 90% of US equity trading volume, according to JP Morgan. So when you're trading, you're not really competing with other people such as yourself. You're competing against the machines and the robots, according to Bloomberg here. So that's revolutionary trading, folks. I think we're kind of at that stage right here. I'll save some time, but this is a video I took years ago visiting the trading floor. So that's what it used to look like. And now here's your competition. No emotion, they run automatically with built-in risk controls. So how do we easily use algo-driven option spreads? Is there such a thing? How can you use these in your portfolio for any market condition? So we're going to talk about why we're doing futures index options and not individual stock options. 3 reasons. First of all, an index is always less volatile than an individual stock. Number second here, too, there are strategies for any direction when you're trading with options on indexes. You can hedge or use directional or non-directional strategies. And of course, with just one market or 2 markets with an index, you don't have to track thousands of different stocks. So let's see why are insurance companies making so much money all the time, and maybe they're smarter than us. You know how they make money. You pay the premiums and they insure you, but they also insure themselves by hedging. And they have probabilities and math on their side. That's all they do, folks, is crunch the numbers. And just like a casino, if a casino here, this roulette wheel here, you bet on that 0, you spin it enough times, you're going to lose $5.26 on average per spin. So that's the house edge. But really, in the long run, that edge is going to pay them handsomely, even though on occasion they'll have to pay you some winnings. So you want to be that the house or the higher probability house, like a Nevada casino here. 9 months of $1 billion in house winnings. Thought that was kind of an interesting headline. So how can you be the house when trading options? Let's see if there's a way we can make that happen. How about some higher probability option strategies where we're collecting premiums using a baseball analogy, a base hits, and we simply sell the options that other people are buying. You have to be consistent and patient. You need to manage your risk, expect to have losers, manage reward. Don't get greedy. You need the proper tool to make this happen because it's almost impossible to do it on your own. So remember, base hits, not grand slams. These are short option strategies. And we're going to target these higher probability outcomes with predetermined risk. We're only doing covered or insured credit spreads. And they might be non-directional in nature. And they have a wide margin of error. So you can see the upper boundary and the lower boundary and the market trading. And I'm going to explain this in just a second. But first, we'll look at two of the Greeks. When we talk about options, you might hear about Greeks, and we don't have to get into the double derivatives and the multiple deep order, of Greeks here. Just delta. First is the approximate probability of expiring in the money. So if a delta is at 0.25, essentially that means there's a 75% chance it expires worthless. And of course, delta is always moving with price and time. And it is not the probability of a winning trade. I want to repeat that. Delta does not mean, in this case, if you were to sell this option with a delta of 0.25, that you have a 75% chance of profitability or making money. That's not what that means. So let's look at theta, time decay. So remember, every option has limited lifespan. So you refer to time as theta. It's a negative number, 1 day of time decay. So if the option premium is 10 and theta is negative 0.05, the next day you'd have 9.95, and after that 9.90. Here's what it looks like on the graph. As you approach time zero, the value drops and drops and drops. And then here is what selling a call spread might look like. We're not going to spend too much time on all the details, but so you can see the upper boundary there. The red line and the blue line are the calls that you sell and buy. You collect 4.5 points, pay 2.25. And then the net result is you collect $112.50 minus your commission. Same thing with the put spread. Here's an out of the money put spread you could sell. You can see here you collect 3 points, you pay out 1, and then the net result is $100 that you collect. And remember, these are not naked options. So no naked creatures here allowed. Your maximum risk is capped. These are called covered spreads. And a couple big advantages to covered spreads: no margin calls. And of course, there is not unlimited risk. If someone tells you to trade naked options because it's easy money, it might be for a while, but then I promise you'll give it all back and maybe more. I've never seen it work in 30 plus years. So that's why we only do covered strategies, like a Condor, an iron Condor. It's a bull put and bear call spread. It's essentially just what we saw combined. Here's the call spread you sell and the put spread that you sell. And then you look for the market to stay in this range. So you collect money on both sides. And we're going to show you how that works. And here's our proprietary strategy. It's called a Dragonfly. It has 6 legs. So it's another income generation type of strategy. The variation on a Condor. So let me spend a moment here and explain this. You sell 4 of these calls You buy 3 further out of the money, and then 1 closer to the money. And the same structure on the downside, selling 4 puts, buying 3 further out, and then 1 closer to the money. You'll note here that the calls that you're selling in this example are 50 points higher than this one that you own. And on the puts, it's the same type of structure. So this changes the characteristic of that spread dramatically compared to a Condor, and I'll explain that in just a second. Now you can even use some of these strategies for bull or bear markets. This is just an example of doing half the Dragonfly. For example, you could simply just do the call side of a Dragonfly and collect premium on the calls. And that's what it would look like. So if you think the market is neutral to bearish, there's something called a bear hedge that we created, the name at least. Very simple. Simply you sell out of the money call spread, and you take the money that you collect and you buy an out of the money put spread. So that's that very simply how that works. But here's people that, you know, I kind of put this guy in here. I think that's Jackie Chan, isn't it? But people say, yeah, that's great, but how do I even know where to start? What strategy to use when? You know, what strikes, what expiration, what price, on and on and on. So that's what Theta Trader is all about. We're going to jump into the demo here in just a second. Pre-built option spreads. Then we'll look at the risk thermal indicator, simple, effective option spreads trading, and risk and profit management. Let me go ahead and switch screens for you here. Okay, you're set. You're all looking at my Theta Trader here. All right, I see some questions coming in, by the way. So yes, keep them coming in. And I'll get to a lot of those here in just a second. But here is the dashboard for Theta Trader. Very simple. You can see current Theta trades. These are the trades the algo is generating. I'll show you that in a minute. These are your open short positions, open bot positions, if any. Here's your account info, pulled directly from your Altavest account. And then any current price quotes. And let's start. You can see there are bullish strategies pre-populated and bearish and non-directional. You'll notice the markets that we're trading: the E-mini, S&P 500, NASDAQ 100, and Russell 2000. So those are the primary markets for Theta Trader. And since we looked at the Condors and Dragonflies, that we'll focus on that. This is just a demo account, by the way. So I wouldn't make too much of the performance one way or another. I just use it for webinars like this. Now, you'll see there are trades from 16 to 71 days till expiration. That's what the algo has chosen. And you'll see that this here is your maximum profit potential at expiration, and there's something called the targeted annualized return at expiration. And this percentage here is really to compare one trade to another. It's not realistic, of course, to expect to place this trade every 16 days and make the maximum profit each single time. So really just use that TAR number there to compare one trade to another. And I like to just go ahead and look at the one with the most days till expiration. Let's drill down on that. Okay, so you'll see this table here, and I'll jump into some of these numbers in just a second. But first, look at a graph. These are the call spread you're selling and the put spread that you're selling according to the algo. And here's the current price. So that's a good overview. And you'll see here the expiration date, days till expiration, settlement value, put risk, call risk, commissions, capital, cash required. Let me show you this here. Here's your net profit potential and the cash required. So your targeted return on cash, just over 13%. And then the TAR there, 67%. Now here are the individual legs that the computer has chosen, the mysterious secret sauce behind the scenes here, our algorithm that we built years ago for this. So you'll see that the 3820 put that you're selling has a delta of 9.88. So that's below 10%, and that means this put option that's being sold has over a 90% probability of expiring out of the money. And look at the call, delta of 6.96, so over a 93% probability of expiring out of the money. And now you could modify this if you wanted, but that kind of defeats the purpose, I think. I think you want to let the algo do most of the work most of the time. And it pre-populates as a sell because you're selling the spread. You could buy it if you wanted. And it always defaults to a quantity of 1. And now if you'd see here, the cash required moves up or down depending on what the quantity is. And you'll notice too that essentially here, let me go back to the 1. So sometimes people will say, well, I'm going to put up $880 to try to make 116 at most. Well, why would I do that? Well, remember, these deltas have that higher probability outcome we talked about. So you have a 90% plus probability that these puts and calls are going to expire out of the money. So with that said, let me change that quantity. We'll just do 4. We'll place that order, and you'll see it just shows up as being filled, just a demo account. Let me go back here. Let me show you another great feature. Before I do, let me just run through a Dragonfly real quickly. Then I'm going to show you the automation and how it gets even easier than this. Let's look at a Dragonfly. We'll look at the June in a month. Imagine how difficult it would be to create one of these trades on your own. It's next to impossible. So here's the chart. It gives you an idea here. In this case, the 48.30 call that you buy is going to be 50 points closer to the money than the 4 that you sell. And the same with the puts here. But that can change depending on what the algo decides to do. Of course, you're selling 4 calls and 4 puts. And again, the deltas are with those higher probability outcomes. Cash required, of course, is higher. Profit potential is higher because you're selling 4 of puts and calls. Targeted return on cash and your targeted annualized return will always be a little bit less than a Condor, an equivalent Condor. And again, that's because you're paying money to buy the 48.30 and the 38.70 here. And those are what you might just call a little bit of additional insurance. So you can see the structure here sets up as a 1 because you're selling, quantity of 1 by default. Let's try 2 of those. And we'll go ahead and place that trade. It's just that easy, folks. Now let me show you a really, really great feature you won't find anywhere else for sure. And if it exists, someone please tell me because I've never seen it. But we have a trade simulator right here. You can go backwards in time and you can backtest these Dragonflies and Condors and whatnot. And I've loaded some already here to save time. So here's on March 4 last year. Here's a trade with 58 days till expiration. It's the April end of month Condor. And we can use this play button to go forward in time, or you can go backward in time. And then you can see here each day goes by. And you can see the P&L changing based on theta decay and market movement. And this green RTI, I'll explain that in a second, but green means good, do nothing. Let's keep playing here. So you can see the trade's turning profitable due to theta decay. Turning yellow now, elevated risk, but still do nothing. Turning orange, even more elevated risk. You can see it's getting close to those upper boundaries there, and the algo is starting to give us warning, flash us a warning signal. Then it goes back to green, back to yellow, back to orange, back to green, yellow, orange, back and forth. And then really basically you have to wait till the last day on that Condor, and then it finally turned profitable. Now remember, that is from March 4, 2021. That's the April end of month. How about that same day, instead of a Condor, you did a Dragonfly? What would have happened? Let's take a look. It turns blue. What is blue? That's your profit taking order. So the Dragonfly turned profitable with 38 days remaining till expiration, and it generated enough profit, over 74% of the total premium captured. You could then close that out and capture that premium there. So this can be automated. I'll show you that too. So if it turns blue for a profit, or if there's too much risk and it turns red, and I'll show you that too, you don't have to screen watch. Theta Trader is monitoring your account, and when it turns blue or red, it will automatically submit those exit orders for you. And let's do another one here. I'll just go right to the end to save some time. So here's a Condor. Remember, I'm showing everything here. No, I'm not trying to hide anything, but here's a trade that on a Condor, you would have taken a loss on the 12th. I'm sorry, on the March 3rd. This would have been a losing trade. And you're actually, good idea that you got out because it just got worse, right? So on that same day, this is the March 2020 Condor placed on January 2. So here, January 2, let's do a Dragonfly. Let me scroll down so you can see it. Turns yellow, turns blue, green, I'm sorry, and then it turns blue. So it gives you an opportunity here to take profits again with the Dragonfly. And that's simply because it's a totally different trade structure compared to the Condor. Again, you own this additional call and this additional put that's closer to the money. In this case, 40 points closer to the money. So here we go with another trade. I don't remember how this turns out. We'll jump to the end here. So this trade here is a Condor. You would have taken a loss on this trade on December 17 with 15 days remaining. So that's the end of month December. So look at the Dragonfly. You can see here, Dragonfly, wanted to show you December 17, you still end up taking a loss. And I want to point that out because I don't want people to say, oh, I'm only showing winners. So just because you have a Dragonfly doesn't mean you'll never take a loss. So just want to point that out to you. But you'll notice too that the loss on a Condor is always going to be, a smaller dollar figure because you only have, in this case, one option that you're selling, whether it's put or call that's being pressured. And the Dragonfly, of course, you're selling the multiples of 4. But let's look at some other examples here. Here's the June end of month Condor. So here's a Condor, and this is pretty typical for a Condor, chopping around, and then over time the theta decay works its magic. So you able to take profits here on June 24 with 7 days remaining. But here's the Dragonfly, and look at that, profit taking order on May 28th with 34 days remaining. So it matured much more quickly, and that can happen a lot of times with the Dragonfly. It gives you opportunities to get out of a trade for a profit much earlier than a Condor might. And there are times when you can get out of a trade for a profit on a Dragonfly and the Condor never turns profitable. So that's why we love the Dragonfly. And let me show you here under your settings. You just go to your account settings here. And this is where you activate your risk manager and activate your profit directive. And then from there, you just save those settings. And then Theta Trader will track and monitor everything for you automatically. So you don't have to screen watch and babysit the trades. So if it turns red, you're out. If it turns blue, you're out. Also want to point out, there's a great help file here. If you want details on how the RTI works, I won't go into all the details, but all the color coding is explained here. And there's also daily research. It's our proprietary research. We do something called TradeScope just only for our clients, giving some forward-looking guidance on what the stock indices are doing. And here's a daily trading commentary that I help write as well. So you can see here new trades from, I think this is yesterday. Yes, or 2 days ago. Sold some call spreads and yesterday as well. So we give an overview here, what happened in Asia, Europe, the US, and what to look for going ahead and any economic data. So that's very helpful and informative for clients. They love looking at that. Now here is how you can at a glance see what your current positions are doing right here on the dashboard. Or you can go to positions here and look at open positions. And you'll see all the open positions on one page. So you can see here, there are 9 open trades on the page. They're all green except the one that is a long put spread. And that makes sense. Anytime you buy options, that's a low probability outcome. So at times we may have people doing long option spreads and strategies, and that's fine. But really the bread and butter should be selling options. That's your higher probability outcome. And then you can go look at your closed positions here. So it gives you a summary here of all the closed positions on the page, and then gives you the P&L, of course, and you can look at any of the history of any trade. Maybe you want to look at this Dragonfly. So you can see I've highlighted it here in gray, and you scroll down, and it gives you kind of a history of that trade. So the first day you placed it here, and then day by day, and then you can see as the trade was starting to mature, getting profitable, turning green, a little bit yellow, but really ultimately it turned blue and worked out just fine. So that's how that works. Now, let me jump to the best feature of all. And I do see some comments and questions, so keep them coming in. I'm going to get to them just a second here. Before I show you that, let me just show you one other thing here. I mentioned the half Dragonfly calls. You can see here, it works just the same way as any of the other pre-built strategies. So you can see in this case, just the call side of a Dragonfly. So if you're bearish, or perhaps you want to do one of those bear hedges we told you about, people love doing these. Here's a May into month. And the benefit of something like this bear hedge is it's not going to cost you anything. Most of the time you can do it for even money or even sometimes a credit. So in this case, you're selling this out of the money call spread, and you use that money to finance the purchase of an out of the money put spread here. And that's what that would look like. So you can do that all through here. But let me go ahead and switch gears. Just a second, folks. Having trouble locating my Zoom controls. So let's see here if I can find them. Ah, there they are. Got 3 monitors to shuffle through here, guys and gals. So plus all these other menus and things, it's A little bit clunky at times, so I apologize for that. Okay. Okay, let's make it easier. Trade alerts. I promise you, you're going to love these. One-touch responsive alerts where you simply accept or reject. That's all you have to do. And these are live and integrated with your Altavest account. So normally you receive an alert right now from some service and you get an email or a text. Then you have to log into your platform and then copy the alert and try to make the trade. With us, you don't have to do any of that. Here's what it looks like. I should probably get a better example here, but so you can see a little more clearly. You'll receive a text, you just touch the link, and it takes you right to the alert page. You'll see a screenshot, a description of the whole thing. I want to point out, it gives you the net premium collected, in this case of a Dragonfly, the cash required, and look here if you can't quite see it. It says selling 5. So it's pre-sized for your account. Every trade is tailored for you and your account according to your account balance and also what other trades that you have in the account. So you can read about the trade, see it. If you like it, you just touch accept, and then that's it. So here's what we're going to do. This is how to get involved with the Tech Wizards special offer. We can get you a Theta Trader membership. It includes, of course, the Theta Trader software with the algo that creates all those option spreads. Our proprietary algorithm does that for you. Simple, effective trade selection. You saw the risk thermal indicator that automates the exit of the trade. You don't have to babysit. So a little bit of autopilot functionality there. Keep the emotions out. We saw how important that was. Then you saw the trade simulator, sort of a one-of-a-kind tool. I mean, you kind of a time machine. You can go back and test these 6-legged option spreads. I mean, nobody's doing that. So you have everything in Theta Trader that you saw. Yearly value of over $3,500 for that software. And then, of course, the trade alerts. So the trade alerts are part of Theta Trader. They all work together, all these features. So that value there, over $4,400 with just those trade alerts alone. We call them one-touch trade alerts. So you have Theta Trader software, which includes the trade alerts, valued at over $8,000. And then you have a private coach. So you can share, the coach will share their screen with you, someone who's licensed and experienced. You have a co-pilot to discuss your trading. Valued at $7,500, I think that's probably way undervalued. I know people are spending $25,000 and $50,000 on trading education tools and materials and courses, and that's all good and well, but with your Theta Trader membership, we're providing what you need. So again, to summarize, valued over $15,500. And then I mentioned briefly our daily proprietary research. That's only available for Theta Trader members. That's valued at over $2,900. I didn't go into it, but there are online tutorials in the software. There are videos, but it is so simple and user-friendly and intuitive, you may not even need it. So you get everything with Theta Trader, $18,500 value. And this is what, in fact, our membership used to be almost $4,000 when we do in-person events. Then we'd have people come to the back of the room and sign up. But we're not going to even charge $29.97 or $7.97. 83% off that retail price, and it is a limited time. And this is our lowest offer ever. That's no joke. That's not hyperbole. I don't want to sound corny, but we haven't done it this low. $4.97. We thought we'd do it because of David and Timing Research and Synergy Traders having us back. So it's one payment for lifetime membership. Take a screenshot of that. That's my direct phone number. And when I hang up, I'll have all sorts of people leaving messages, and I'll be here and answering the phones as much as I can. And I have other people answering right now too. So if you wanted to call, someone should answer. But there's the link as well, or you can go directly to that link and just complete the order form. One page, very simple. Most people just go to the page, complete the order form. No excuse, folks, 30-day guarantee on that membership. So $497, and that's, again, let me show you. Lifetime member, one payment. It's not every month, not every quarter, not every year, just one time. That's it. Few FAQs. Are futures options tax efficient? Yes. I don't want to spend all the time going into this, but yep, thanks. There's the link on the screen there, folks, in your chat. If you're trading individual stocks in this example, you get a rate of return of 12.6%. If you're trading with us and you have that same result, you'll have a rate of return of 14.64%. Tax savings over $2,000 because of the tax efficiency. Basically, your gains are taxed at the 60-40 split. 60% of the gains are taxed at the long-term capital gains rate, which is always lower, almost always lower than your individual tax rate. So there's no more itemizing as well. That's a big benefit. No wash sales or anything crazy. IRA accounts, yes. We get lots of IRA accounts, so contact us if you have comments or questions on that, but there may be some financial or experience requirements, but anyway, you can just have an IRA self-directed account, just like Forbes talks about here. And why the E-minis? Well, those are the reasons right there. Liquid, efficient, cost-effective. Here's one bit of trivia. The E-mini, S&P 500, it outtrades all ETFs around the world by over 2.5 times. It's almost 10 times greater than the SPY in terms of average daily dollar volume. So this is where the activity is, folks. I won't go into every detail here because I don't want to run out of time, but volume, liquidity, superior execution compared to the SPX, savings of 4 to 15 per contract, tight bid offer spreads. I'll go quickly here, but this is really important. I'll slow down. If you think you can do the Dragonflies on a stock or in the security space, you can't do it as one order. I've tried it on multiple platforms. I've seen other people online try it. What they do is they have to break it down into 2 separate orders. And then you have to try to leg out and leg in. It's just a mess. The way we do it, it's traded on one order, placed as one object at one price, one net price. You get in at one price, you get out at one price. No legging in and legging out and breaking up things. ES options have largest market shares. You have all the strike prices to choose from. So here's an example of the short calls and puts on a, let's say, a Dragonfly. And then here's another one here and another one here as time goes by. So you're going to be able to get these orders filled because there's so much liquidity. You're tracking, of course, just a couple markets, efficient margin use, clear cost structure. I won't jump into this too much, but remember, we're trading futures options at the CME Group, largest futures exchange in the world. These are all electronically traded on Globex. So that means every order gets equal treatment. They all trade in the same place. If you're trading stocks and stock options, your orders are being filled by third-party market makers, like the payment for order flow nonsense. So, Robinhood here, they get fined $65 million. They have inferior trade pricing, costing customers $34 million. You're saving a penny to lose a nickel. Nothing of value is truly ever free. I think that's a great comment, period. David Einhorn says, payment for order flow is disguised commissions. If you want the broker to work, you better pay a commission. And that leads to the question, well, what are the commissions? Our rates are very competitive at 5.25 round turn all in. And if you see other rates published, like here's an example, I took a screenshot. It's a big box brokerage firm online, and they say they're at 2.25 for their futures options. Well, that's per side, and then they add clearing and exchange fees on top, and that's ending up higher than what we charge. So our rates are very competitive. And I shall point out that everything I showed you in Theta Trader is net. So I highlighted that there. Everything is net of all trading costs. And everyone makes their own decisions with Theta Trader. So performance is, of course, all different for every client. They're self-directed. What size of an account? If you want to diversify with various Dragonfly strategies and Condors at different strikes and expirations, minimum at least 20,000, perhaps even 25 as a minimum is a better number. And if you want a free account, people love this offer. Take a look at that. You have an account of $50 to $99,999, you get a 50% rebate on that membership. And 100,000 plus, we'll just rebate that entire membership fee to you. No questions asked there. So people love those offers. Types of accounts, you name it: IRA, individual, joint, corporate, LLC, trust, and alternatives. So why even, why alternatives? They may improve diversification, lower portfolio risk. Remember, inflation's at a 40-year high. There's commodity prices. This is kind of a little bit of hyperbole, but inflationary hell that's about to break loose from David Stockman. But the money, is being picked from our pockets. Meanwhile, the Buffett indicator, stock market to GDP ratios at near a record high. But how about 10-year stock market returns? Let's look at this here. Here's a lost decade for that 60-40 portfolio of stocks, according to Goldman Sachs. Lost decades are more common than you think. And this is interesting too. What will the next years look like? Will they look like the last 2 years? Don't bet on it. Look at this here. 34% loss at Tiger Global Hedge Fund just this first quarter. Low faith in the Fed, according to an RBC survey. Atlanta Fed GDP now backing down their growth down to projection down to 1%. IMF slashing its global growth outlook. Stagflation fears are soaring as the World Bank slashes its global growth outlook. U.S. is headed for a recession. This Wall Street Bank thinks so. I think that was JPM. Goldman traders saying they've never seen a setup quite like this before. Goldman slashing its 2022 forecast. China, this is crazy. Look at their GDP. Worst quarter ever in China. And it says here, the next 10 years don't look so good. This is kind of interesting. It's a statistic here. I'm going quickly, but got limited time. This statistics here says, called R squared. It's predicted 70% of the changes in the stock market's 10-year return. And right now, the indicator is projecting a minus 4.2% annualized in the next decade. You don't want unrealistic expectations. I'll just show you that people are expecting 17.5% returns as what a typical investor is expecting now. Investment advisors are thinking more like 6.7%. That might even be optimistic. And then here, I want to show you this here, the benefits of sidestepping bear markets. See these red periods, the dotted line here. You start a bear market and it didn't recover for another 10 years. Another bear market took another, 7-8 years to recover. It says here, it took 6 years after the tech crash and 5 years after the financial crisis to regain to prior highs. So I thought it was more like 7 or 8, but 6 and 5. So remember this, folks, self-evident, but if you have a big drawdown in your account, maybe 40%, you have to gain 67% just to get back to break even. And then this is a good one to look at. 22-year period of time here, 25-year period of time, 17-year period, 12-year period of time where the market gives you 0% returns. So remember, there can be long periods of time where the market's not going to generate a positive result for a passive investor. So we like Theta Trader. It gives you an alternative approach, what they call a non-correlated approach. And I'll leave this up here, but real quickly, the 5 steps, you just complete that order form I showed you with that link here. You'll get your Theta Trader login credentials and an email with your account opening link. And then once your account's open, you just send the money and start trading. So it's that simple. Unfortunately, we can't do Canadians, but thank you for asking. I wish we could. You need a legal US residence. And let's see, I talked about the commissions, and we are the brokerage firm. So yes, we are Altavest since 1997. This is our technology. So thank you for asking. And someone mentioned Jim Cramer there. Yeah, so UK, yes, you can trade with us in the UK. Australia, UK. The EU countries are difficult, but please ask us. And again, it's not us. It just happens to be the regulatory environment and landscape. As someone asked about commissions, we touched on that. Remember, everything is net of commissions. And really, quite simply, you open your account and you'll start receiving trade alerts. And as you accept the trade alerts and you have like a Dragonfly that matures, then you'll have other trades to accept. And, over time, the one trades, mature and the other trades come on. So it's just kind of like a rolling cycle of keeping your account allocated. So it works quite well. Yeah, and we're always available. So once someone wants to know about how many personal coaching sessions, well, that's our job. So we're different. We're not Robinhood. We're not chatbots. We're real people. We're professionals in the business doing this many years, licensed to help people. And we want to see you succeed. If you succeed, we succeed. So hopefully everyone can hear me okay. I had a little bit of a frog in my throat this morning, but all right, very good. But I think that's going to wrap it up. Oh, minimum accounts. The bare minimum is 20,000, but really you should probably try to have a little bit more. And the reason why is that Dragonfly is about 5,000. And, if you have $5,000 of 20,000 in one trade, that's 25% of your account allocated to one trade. That's kind of a high concentration in any one particular trade. And that's really the reason behind it. But yeah, certainly we'd love to have you come on board and be a happy client with us. We've been doing this many, many years, and we developed Theta Trader because we had thousands of clients trading options with us, and we needed some technology to help us find a better way. So that was the catalyst, and now you can benefit from all of our experience and using Theta Trader. So thank you very much. Oh, let's see here. Someone asking another question. Yeah, it's just a one-time membership fee, $497. You see that right there. One time, and there's a 30-day guarantee on that. If you sign up and it doesn't work out in the 30 days for some reason, you change your mind or whatever, just let us know. We don't really care too much about the membership fee. We're not holding you hostage. So, all right, very good. Thank you very much. And I'm going to wrap it up.